Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, a blockbuster 4.3% GDP print triggers pre-market chaos, but stubborn inflation data sparks alarm bells. Will the bulls charge at the bell, or is this the perfect setup for a Fed-induced reversal? Second, GDP boom hides consumer collapse, 4.3% growth fueled by dwindling savings. The consumer spending surge is a final hurrah, with savings rates plummeting. Is this a warning sign of an imminent demand shock? And will consumer discretionary stocks be the first to fall at the open? Finally, AI's high-stakes bet. Fed model predicts a 7% productivity surge versus a 23% job apocalypse. The market is pricing in a productivity miracle, but with valuations nearing dot-com peak levels, is a sharp correction in AI stocks now inevitable? Warning, the S&P 500 is painting a deceptive masterpiece. We are seeing record highs on the surface, but underneath, the foundation is cracking as volume dries up and consumer confidence collapses. This isn't a celebration. It represents a critical inflection point where macroeconomic data and consumer sentiment are violently colliding. The S&P 500 closed near 6,917, edging up roughly 0.5%, while the Nasdaq pushed higher by 0.6%. But do not let the green numbers fool you. Trading volume has shrunk to approximately 14 billion shares, thin holiday liquidity that is masking a dangerous lack of breadth. The gains are narrow, driven almost exclusively by mega cap technology, while the rest of the market watches from the sidelines. The divergence between the steady Dow and the tech-heavy Nasdaq confirms that capital is still crowding into a handful of names, creating acute concentration risk. Why is this specific moment so treacherous? We are staring at a massive disconnection. On one hand, third quarter GDP shocked the street with a 4.3% annualized expansion, signaling robust economic activity. On the other, the Conference Board's Consumer Confidence Index has plummeted for the fifth consecutive month. The Present Situation Index, a measure of how consumers feel about current business and labour conditions, just collapsed to its lowest level since the pandemic. This creates a Goldilocks dilemma for the Federal Reserve. The strong GDP print pushed the 10-year Treasury yield up to 4.17% as bond markets aggressively reprice the expectation for 2026 rate cuts. Traders who are betting on a dovish Fed pivot are being forced to retreat. From a valuation perspective, this is critical. A 10-year yield pushing toward 4.2% raises the discount rate for future cash flows, which historically forces a compression in price to earnings multiples for high-growth stocks. Analysts point out that if yields sustain these levels, the Nasdaq's current valuation premium becomes mathematically difficult to justify. Capital flow analysis shows smart money is already reacting to this rising cost of capital. We are seeing a quiet but distinct rotation out of high-beta cyclical stocks and into defensive fortifications. The market is effectively saying that while the economy is growing today, the consumer is signaling a hard stop for tomorrow. Nowhere is this tension more visible than in the technology sector. Nvidia continues its Defy Gravity Act, adding billions in market cap to reach a $4.35 trillion valuation. However, the real story is Broadcom. Up 2.2%, Broadcom is emerging as a diversified alternative for AI infrastructure, benefiting from massive custom chip contracts without the same single supplier risk that plagues other semiconductor names. The market is beginning to favor the suppliers of application-specific integrated circuits over general-purpose processors as the AI build-out matures. But look beyond the AI glare. A significant rotation is underway into healthcare. This sector delivered a stunning 93% earnings beat rate in the third quarter. Companies like Eli, Lilly, and United Health are attracting institutional capital seeking refuge from stretched tech valuations. Healthcare trades at roughly 21 times forward earnings, a massive discount compared to the 40 or 50 times multiples seen in mega-cap tech. Experts note that this sector offers structural tailwinds from an aging population without the extreme valuation risk found in the semiconductor space. Simultaneously, look at the fear gauge. It isn't the VIX, it's gold. Gold has shattered records, trading above $4,500 per ounce. This isn't just inflation hedging. It is a geopolitical alarm bell ringing over US-Venezuela tensions and Middle East instability. When equities hit all-time highs and gold hits all-time highs simultaneously, it signals that sophisticated investors are hedging against a major volatility event. They are buying the rally in stocks with one hand and buying insurance in precious metals with the other. The market rhythm has shifted from aggressive accumulation to strategic defense. The divergence between macroeconomic growth and microeconomic pain cannot persist indefinitely. The next few sessions will determine whether the liquidity tide lifts all boats or if the consumer recession narrative finally forces a repricing. Keep a close watch on the 10-year yield. If it crosses 4.5%, the rules of engagement change immediately. Let's start with a single statistic that might just change your entire perspective on this economy. 4.3%. After weeks of markets celebrating softer inflation and leaning into the rate cut soon story, today's blockbuster GDP number shifts the entire conversation from soft prices to hard demand. That's the third quarter growth rate for the US economy, and it didn't just beat expectations, it blew past the 3.2% forecast, fueled by a surge in consumer spending. But that's not the whole picture. The real turning point is what's powering that spending. Believe it or not, this surge looks like a last hurrah because the personal saving rate has fallen to just 4.7%. It suggests households are burning through their pandemic era savings to keep the economy hot. And, that's just not sustainable. If policy isn't truly restrictive, easier financial conditions can stretch a cycle. But if it's running on dwindling savings, the floor can give way fast. So, heading into the open, keep an eye on consumer discretionary stocks. They could see some serious volatility. And corporate America was cashing in. Profits soared by jaw-dropping $166 billion in the quarter, a 4.2% jump. The big question is where those profits came from. Research suggests it's less about efficiency and more about pricing power, passing higher costs directly to consumers. These historically high profit margins are now very vulnerable. If consumer demand, fueled by those savings, begins to weaken, these record profits could evaporate. This is where the situation takes a more complex turn. Beneath that explosive growth, inflation is proving stubborn. The Fed's preferred gauge, the PCE price index, rose to 2.8%, still well above the 2% target. And when you dig into the details, the quarterly PCE price index, when annualized, actually accelerated to 3.8%. This indicates underlying inflation is far more persistent than the market was hoping for, pushing back hard against that earlier rate cut narrative. This creates a major tug of war for investors. The data gives the Federal Reserve more ammunition to argue for keeping interest rates higher for longer. And the Fed is laser focused on one metric in particular, real final sales to private domestic purchases. Think of it as the core measure of demand. That number jumped 3.0%, signaling to the Fed that underlying demand is simply too hot to justify cutting rates. Stock futures are already reacting, holding slightly negative. So, as we approach the opening bell, the battle is clear. A booming economy versus a potentially hawkish Fed. Watch that 10-year Treasury yield. If it climbs, it means bond investors are taking the Fed seriously, which could spell trouble for growth stocks like the QQQ. Speaking of the immense pressure on the Fed, another major economic story is unfolding, one that could change the game entirely. A new economic model is putting a number on the table that could redefine the next decade. A potential 7% annual productivity increase, all driven by artificial intelligence. That's from research co-authored by a senior economist at the Federal Reserve Bank of Richmond. The situation presents a fascinating duality. On one side, this incredible productivity surge, while on the other, it exposes a scenario where 23% of workers could lose their jobs. Now, get this, the initial impact might not be a sudden spike in unemployment, but something economists call labour market churn, a massive wave of job-to-job movement and growing skill mismatches. It could make it much harder for the Fed to get a clear read on the labour market's health. This isn't just an academic theory anymore. Fed Chair Jerome Powell himself has acknowledged the potential, but his caution is palpable. We're going to have to see. His hesitation is rooted in the productivity paradox, something we saw in the 80s with computers. It took years for those investments to show up in the official stats. We may be entering a similar phase with AI, creating a huge risk that the Fed could misjudge the economy's potential and tighten rates prematurely. Interestingly enough, this isn't just a US phenomenon, it's a global AI capital expenditure arms race, with China racing to counter the US private sector boom. This competition for chips and energy could create unique inflationary pressures. But the high valuations are also raising flags. One chief investment officer noted the run-up makes us a little more cautious. When we place the current investment frenzy in AI alongside the soaring investment to sales ratios of a company like Cisco during the dot-com bubble, the contradiction becomes clear. The risk is that if these massive investments don't lead to equally massive profits, a sharp correction in these AI bubble stocks could be on the horizon. And this all boils down to a concept that could rewrite the Fed's playbook, the neutral rate of interest, or R star. For years, this rate has been falling. But if AI delivers on its productivity promises, it could push R star structurally higher. So the thing is, if the true neutral rate is higher than the Fed thinks, it means current policy is actually more stimulating than it appears. This could force the Fed to keep rates higher for much longer than anyone expects. At the open, watch how bond markets react to this idea. Any upward pressure on the 10-year yield could signal that the future might involve structurally higher interest rates.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.